All right, let's get right into it. Today, we're going to break down the economics of generative AI, specifically for all you strategic investors out there. We're going to look at where the money is flowing right now, and maybe more importantly, where the real long-term value is going to end up over the next decade.
So let's kick things off with a question that's on every investor's mind. Everyone's calling this a new gold rush, when instead of picks and shovels, we've got GPUs and foundation models. So in the middle of all this frenzy, who's actually getting rich?
Well, the answer, right now at least, is pretty simple. It's the folks selling the shovels. I mean, this chart just says it all. Of all the gross profit in the entire Gen AI ecosystem, a staggering 79%, nearly 80%, is being captured by the semiconductor layer. That's the hardware. Everyone else, from infrastructure to the apps you and I use, is basically fighting over scraps. And this is, well, it's pretty weird, right? We call this an inverted value chain. All the economic value is getting sucked down to the very bottom of the stack, to the compute hardware. In almost any other mature tech market, it's the exact opposite. Value flows up to the applications. But here's the thing. This isn't the first time we've seen this happen.
Here's how we're going to tackle this. First, we'll look at this inverted economy. Then, we'll compare it to the cloud. We'll pull out history's playbook, talk about the custom silicon gambit, see how the stack might flip, and finally, lay out the decade-long bet.
Okay, so let's really dig into this inverted structure, because you have to understand just how lopsided the market is today to see the opportunity tomorrow. And this isn't just a profit story. The revenue numbers tell the exact same tale. Out of a projected market of around $435 billion, the chip guys are taking home about $300 billion of it. And get this, even though the whole market has exploded, growing 5x in just 2 years, the hardware layer has just soaked up almost all of that growth. It just dwarfs everything else. Now, where this whole thing gets really interesting is when you put it side by side with the last huge platform shift we saw, the cloud. To really get a handle on where AI is headed, you have to look at where the cloud has been.
Visually, it's a super simple concept. The AI stack today looks like an inverted A. It's super heavy at the bottom with all that hardware. But the mature cloud stack, that's a classic V shape where all the value, all the weight, is at the top with the software applications that people actually pay for.
And when you put the numbers side by side, wow, it is just night and day. In the cloud, applications capture 70% of the profits. In AI, a tiny 7%. Meanwhile, look at semiconductors. In the cloud, it's just 6% of the profit pie. In AI, it's that massive 79%. The AI stack is literally an almost perfect mirror image of the cloud.
So, the big question is this inversion just a weird blip, or is it part of a predictable pattern? Well, the good news for us as investors is that history gives us a very clear playbook. We have absolutely seen this movie before.
Just think back to the mobile wave. In the early days, who made all the money? The component makers, the semiconductor guys. Then, the value shifted up a layer to the infrastructure, the app stores. But eventually, where did the real, massive, long-term value end up? In the application layer. Companies like Uber, Instagram, that's where the fortunes were made.
And that's exactly where we are with AI right now. We are square in the first inning. This is the big, expensive build-out phase. And of course, the hardware providers are dominant. They have to be. They're laying the foundation that everything else is going to be built on top of.
So what's going to be the catalyst? What's the thing that's going to flip this whole stack on its head? Well, it's a $1 trillion bet being made by the biggest players in the game, custom silicon.
The amount of money being thrown at this is just mind-boggling. The top 5 hyperscalers are on track to spend over $600 billion in a single year on new infrastructure. And about 3/4 of that is going straight into AI. To put that in perspective, every couple of years, they're spending the entire market cap of NVIDIA. It's just a staggering amount of capital.
And here's their brilliant strategy. They aren't just buying chips anymore. They're building their own. Google's had its TPU program for years. Amazon's got Trainium. Microsoft has Maya. Every single major player is pouring billions into developing custom silicon to control their own destiny, optimize performance, and most importantly, claw back some of that margin from the hardware guys.
Of course, the incumbent, NVIDIA, isn't just going to sit back and watch this happen. Their CEO, Jensen Huang, has been pretty dismissive, basically saying, hey, a lot of these custom chips, or ASICs, end up failing. And you know what? He's not wrong. This is an incredibly difficult and expensive game to play.
Okay, so that brings us to the main event, flipping the stack. How does this immense pressure on hardware costs, combined with some clever moves at the top, finally cause this inverted pyramid to turn right side up?
So for the app companies, how do they get their margins up from that pretty grim 33% today? Well, there are basically 4 big levers they can pull. First, better pricing, obviously. But the real magic happens on the tech side. Custom silicon lowers their total cost of ownership. New, more efficient model architectures are coming online. And then you have these clever cost reduction tricks like distillation and quantization, which basically make models cheaper to run. These are the engines that are going to drive profitability in the application layer.
And this all leads to what is probably the most important part of this whole discussion for investors, the timeline. Because, look, it's one thing to say the stack is going to flip. It's another thing entirely to know when. The pace of this change is everything.
And look, the data we have so far, it's a bit of a reality check. Even with that 5x growth in the whole ecosystem, the basic shape hasn't really changed much. The chip layer's profit share only dropped by about 8 points. That tells us this is not going to be a quick transition. Not by a long shot.
If we need a guide, all we have to do is look back at the cloud. It took about 15 years. 15 years for that whole thing to mature, for the value to really shift from hardware to software. It's very likely that AI is going to follow a similar decade-plus-long journey.
So what's the takeaway here? The biggest, most wide-open opportunity is still sitting there in the application layer. But the question for investors really comes down to timing and patience. Right now, today, the profits are absolutely in the shovels. But the playbook of history tells us that eventually, the gold miners, the application companies, are the ones who will build the lasting value. The real challenge is just navigating that long and winding road from here to there.